G'day, welcome back to this series on fundamental analysis. If you missed the first video in the series, I'm going through how elite traders and investors go about making money consistently in the market. So now in this video, I'm going to delve into the actual specifics of how we go about it. So the key parameters that I'm going to look at in this video, and it's going to be in two parts. The first one is to do with total shareholder return. That's where I start. I look for stocks that have got well above average total shareholder returns. And I'm targeting stocks in the 20 to 60% per annum average returns. And those averages are generally struck over a period of at least 3 to 5 years. I'll also have a look at return on equity, which is the key driver of financial performance of stocks. I'll also be looking at the profit per share figures. That's a real good indicator, and I'm looking for solid growth here. Not necessarily some spectacular results from time to time, but consistent, solid performance over time. So let's have a look at the first one, total shareholder return. It's basically the capital gain that you make on the share price plus the dividends that the company pays out either 6 monthly or annually. It needs to be measured over at least 3 years, preferably 5, to be meaningful. A 1-year snapshot really could be either good, bad, or indifferent. Doesn't really tell you very much. So you need to be looking over at least 3 to 5 years. Now, what most large companies deliver is single-digit average returns, somewhere between 5 and maybe 10%. Some of the bigger companies that would really amaze you are actually not generating any net shareholder return at all. It's actually negative, and that's largely because the share price is in decline. And very few large companies are consistently above 10%. Let's have a look at a few returns just to give you a bit of a sense of what they look like. Now, AMP, obviously one of our biggest financial companies, total annual shareholder return per annum, averaged over the last 5 years, is actually slightly negative. Despite the fact that they pay dividends, they've lost more value on the actual share price than they've paid out in dividends. BHP was going extremely well, but obviously the share price decline in the last period has taken the real edge off that, and their return is only about 6% per annum. Telstra comes in at around 12% per annum, Woolworths 10%, and National Australia Bank 15%. And of course, those returns have been after very substantial run-ups in share price, particularly in Telstra and NAB over the last year. So they may be sort of slightly inflated. Now let's have a look at growth stocks. So those first ones on the left-hand side were what I'd call mature stocks. They've been around for a long time. They're big and they're not really in a position to grow their returns quickly. So let's have a look at some high growth stocks, which is where I place most of my emphasis. Telecommunications company MTU, 68% per annum return over the last 5 years. ARP, manufacturer of four-wheel drive equipment, 33% per annum. iiNet, also in the telecoms space, 41% per annum. And just a couple of others to round it out. Credit Corp in financial services, 76%, and realestate.com, 54%. So you can see there is a massive, massive difference between the sort of total shareholder returns from stocks in their high growth phase and those in their mature phase. And if you do your homework well, these growth stocks aren't any more risky than the big mature stocks. So let's have a look at what is possible. Well, I believe with established ongoing growth companies, like we saw with those growth stocks I just had on the previous slide, 25% per annum ongoing is very realistic. Now, I don't expect them to be able to sustain the 50 and 60 and 70% levels that they've had because they've been coming off a low base. But I certainly believe that 20-25% per annum is sustainable for the foreseeable future. And if you can get in early enough on these, then we can replicate what's happened over the last 5 years with a number of these stocks. And 50% per annum with emerging growth companies is absolutely possible because it's just been happening. So there's no question about that. Now, how do you go about gaining the most advantage from that? Capital gain has the largest impact in high growth companies. Yes, they pay a dividend, and yes, the dividends are growing strongly, and we'll have a look at dividends in the next video in the series. But capital gain has the biggest impact. So therefore, the focus needs to be on buying into those stocks after sell-offs and when the price is below what I call fair value. And again, in a later video in the series, I'll actually go through the process of how I determine fair value. Now let's have a look at return on equity, which is the next significant driver of share price performance. So if you want to calculate return on equity, it's the net profit divided by the shareholder equity on the balance sheet. And I'm targeting for above 15%. Now, if you put your money in the bank at, let's say, 3 or 4%, then your return on your equity is 3 or 4%. When you invest in a company that is returning, let's say, 20 or 25% return on equity, then that's the return that you're getting. That's not to do with the share price, but that is the return that the company is generating on your money. And eventually that value will come out to you in one way or another, either through increased dividends or through an increase in share price. Now, what it really means, high return on equity is a really strong indicator of the efficiency and the skill of the management team. You don't get strong and consistent return on equities by good fortune. And it's absolutely the key driver of long-term performance. That's been demonstrated by various studies. So let's do a bit of a reality check. Most companies have a poor return on equity below 10%. But the very best companies are consistently above 25% and up to 75%. Now let's have a look at profit per share as the third element of the fundamental analysis process, or otherwise known as earnings per share. So the calculation is the net profit divided by the number of shares on issue. And again, I'm targeting a level above 15%, averaged over at least 3 to 4 years. So that's the hurdle that I've set. And I'm seeking consistent growth. I would rather have a good steady 15 or 20% than 50% one year and nothing the next year, all over the place. I'm looking for predictability. Now, estimating the future earnings per share is obviously a key thing. We can look at history and that'll tell us what the company has done, but it's absolutely critical that we look at what the next couple of years is likely to produce. So the past consistent performance is a starting basis, because if the company's been consistent in the past, then there's a pretty good chance that their performance in the future will be predictable. The second thing I need to do is then consider the economics of the sector. And I tend to take a quite conservative view. So if the company's been growing very strongly, then my future earnings forecasts will be considerably lower than that. And you also need to consider management guidance and their track record. So if management has got a very strong track record of producing what they say they will, and they're, let's say, providing guidance of 20% growth in earnings for the following year, then it becomes a lot more believable than a company that's perhaps putting out these forecasts but never meets them. Now, there's some limitations of analyst forecasts about the future. They tend to be slow to upgrade or downgrade forecasts, so that's something to be aware of. And they are, of course, based on assumptions about the future. And assumptions, of course, are only as good as the people making them, and that's why it's important, I think, to be conservative when you're making assumptions. Now, in the next video, I'm going to go into some more detail on how to analyse properly. So it's the second phase of this fundamental analysis. And I'll be looking at dividends, and this is really critical. This is an often overlooked aspect of long-term investing. And I'll be looking at the most important aspects that you need to watch. I'll also be taking a look at debt levels and valuation ratios. Look, I love all this stuff. I've been doing it for 30 years, and I've put out a lot of free information which you can access at our website. So if you'd like me to send you a weekly update, then just fill out the form on the site. This weekly update outlines the key things that are impacting our market, plus a strategy overview. I'll also send you videos teaching my key principles of creating consistent profit and longer-term wealth. I really want you to gain a big edge on the market and on everybody else. So click on the button on this video or in the description below and join in with our community of traders and investors. Cheers for now.